When might the Federal Reserve begin reducing interest rates? Insights from investment strategists provide valuable perspectives. That's a question many of us find ourselves pondering, especially in today's dynamic economic landscape. Let's start with the basics. The Federal Reserve, often referred to as the Fed, is the central bank of the United States. It plays a crucial role in managing the country's monetary policy, which in turn influences your personal finances. One of the key tools the Fed employs is the manipulation of interest rates. These rates have a ripple effect, influencing everything from your mortgage payments to the returns on your savings account. Recently, the Federal Reserve has made the decision to hold interest rates steady. This move comes despite a wave of hotter-than-expected inflation data. Inflation, as you may know, is the rate at which the general level of prices for goods and services is rising. When inflation is high, your purchasing power is eroded. The Federal Reserve often responds to high inflation by raising interest rates. However, in this case, they've decided to hold steady. Why? Well, according to Christina Hooper, Chief Global Market Strategist at Invesco, it's likely that the Fed will start cutting interest rates by the end of the second quarter. The US economy is also expected to dodge a recession as the Fed carefully calibrates its interest rate policy. This is a delicate balancing act. If the Fed raises rates too quickly, it could plunge the economy into a downturn. But if it's too slow to act, high inflation could continue to eat away at your buying power. The last time the Fed raised interest rates was in the summer of 2023. Historical patterns suggest that we might see a rate cut about 8.5 months later. That's not a guarantee, but it's a possibility we can't ignore. So what does this mean for you and your money? Let's delve deeper. When the Federal Reserve adjusts interest rates, it directly affects your borrowing costs. Indeed, the choices made by the Federal Reserve reverberate through the economy, impacting both consumers and businesses in significant ways. Let's take a closer look at how these decisions have shaped the financial landscape in recent times. During the pandemic, the Federal Reserve used its monetary policy tools to manage inflation, a necessary but not always popular move. It raised borrowing costs, affecting everything from mortgages and credit cards to auto loans and other forms of lending. This action did not occur in a vacuum. It was a response to high inflation, a spectre that loomed large over the economy, threatening to destabilize it. The decision to raise interest rates was not without its consequences. For consumers, it meant higher costs to borrow, affecting their ability to finance homes, cars, and even everyday purchases. For businesses, it meant increased costs for loans and credit lines, which could impact their operations and growth strategies. However, in the grand scheme of things, this was a necessary measure. The inflation rates had climbed significantly, reaching a peak in the middle of 2022. Even though it has since declined, it's still hovering well above the Fed's 2% target level. The goal of the Federal Reserve's actions was to rein in this rampant inflation. But as with any economic strategy, timing is everything. The question has become at what point and how quickly should the central bank start to cut rates to avoid pushing the economy into a downturn? The answer to this question is critical, as it could determine the financial future of both consumers and businesses alike. Recent statements from the Federal Reserve Chair Jerome Powell suggest that the central bank may not be far from throttling back. Despite hotter-than-expected inflation data, it appears that by the end of June, the central bank could start reducing borrowing costs. But the question remains, when will the Fed start to cut rates to prevent an economic downturn? Experts have different predictions about when the Fed will start cutting rates. In the grand game of economic forecasting, opinions are as varied as the voices that express them. Let's consider some of these voices. Christina Hooper, Chief Global Market Strategist at Invesco, forecasts the Fed to begin reducing borrowing costs by the end of June. She projects cumulative cuts of 0.75 percentage point or even a full point in the year 2024. Hooper cites history as a guiding principle, noting that in previous interest rate hiking cycles, the central bank began cutting rates about 8.5 months after the last rate hike. On the other hand, Jenny Johnson, President and CEO of Franklin Templeton, expects the central bank to begin cutting rates later in the year, specifically during the Fed policy meetings in July or September. These predictions are not set in stone and have shifted over time. Moira McLachlan, Senior Investment Strategist in AllianceBernstein's Wealth Strategies Group, once anticipated 5 or 6 cumulative rate cuts this year. Now she predicts a more conservative 3 or 4, with the firm's base case being cumulative cuts of 1 percentage point in 2024. As we listen to the chorus of these forecasts, we see a common thread: change. Predictions are not static, they evolve with time and circumstance. The same applies to the economic landscape. It's an ever-shifting terrain with interest rates as one of its most influential variables. The question on everyone's mind is, at what point and how quickly does the central bank start to cut rates to avoid plunging the economy into a downturn? While the answer remains elusive, we can glean some insight from Fed Chair Jerome Powell's recent statement that the Fed may not be far off from throttling back. However, despite the uncertainty, strategists are optimistic about the US economy's ability to navigate the interest rate policy. They expect the US to dodge a recession, achieving what's known in economic parlance as a soft landing. The journey may be fraught with turbulence, but the destination holds promise. You might be wondering, what does a soft landing mean in economic terms? Well, it's not as fluffy as it sounds. A soft landing is a term used to describe a situation where an economy slows down, but does not enter into a recession. It's a delicate balancing act, where the Federal Reserve, or any central bank, will attempt to control inflation and economic growth without causing a downturn. It's like flying a plane, with the economy being the aircraft and the central bank the pilot, trying to land the plane smoothly without causing a crash. The concept of a soft landing is particularly relevant today, given the Federal Reserve's recent decisions. There is a general expectation among strategists that the US will achieve a soft landing as it navigates through its current monetary policy. Despite the hotter-than-expected inflation data and the raised borrowing costs for consumers and businesses, the hope is for the economy to slow down just enough to control inflation, but not enough to cause a recession. Strategists like Christina Hooper, the Chief Global Market Strategist at Invesco, and Moira McLachlan, Senior Investment Strategist in AllianceBernstein's Wealth Strategies Group, are optimistic about this outcome. They believe that the US is likely to avoid a recession, thanks to the Fed's careful calibrations of the interest rate policy. As McLachlan put it, a soft landing is our best guess in terms of where we're going to be. However, it's not all smooth sailing ahead. There are concerns about the timing of the Fed's rate cuts. As Hooper noted, there is worry that the Fed may be too late to start cutting, which could potentially disrupt the soft landing. So, while there might be concerns about the timing of the Fed's rate cuts, there is hope for a successful economic outcome. It's a tricky path to navigate, but with the right adjustments and responses, the US economy might just land softly, avoiding the harsh impacts of a potential economic downturn. Let's summarize what we've learned about the impact of the Fed's decisions on your money. We've delved into the Federal Reserve's decision to hold interest rates steady, a choice influenced by recent inflation data that's been hotter than anticipated. The central bank's decision has significant implications, affecting borrowing costs for consumers and businesses alike. During the pandemic, the Fed raised these costs to curb high inflation, pushing up rates for mortgages, credit cards, auto loans, and other forms of lending. Despite a decline in inflation from its peak in mid-2022, it remains well above the Fed's 2% target level. This raises the question, when and how quickly will the central bank start cutting rates to prevent the economy from going into a downturn? Predictions suggest that despite the recent inflation data, the Federal Reserve is likely to start reducing borrowing costs by the end of June, with cumulative cuts of 0.75 or 1 percentage point expected in 2024. Now, let's recall the concept of a soft landing. It's a term used in economic jargon to describe a scenario where the economy slows down without entering a recession. Strategists are optimistic about the US achieving a soft landing as it navigates the complexities of interest rate policy. The expectation is that we'll manage to avoid a recession, but there are concerns that the Fed may be too late in starting to cut rates. Looking back in history, we observed that the Fed last raised interest rates in summer 2023. In previous interest rate hiking cycles, rate cuts began approximately 8.5 months later. This historical pattern suggests that we may see rate cuts this year, possibly in the second half of 2024. In conclusion, the decisions of the Federal Reserve play a pivotal role in shaping our economy. While these decisions can seem complex, understanding them can empower you to make more informed decisions about your money. Remember, knowledge is power, especially when it comes to your finances. While the decisions of the Federal Reserve can seem complex, understanding them can help you make more informed decisions about your money.